We've spent a lot of this year talking about travel. It's been the strongest sector of consumer discretionary, and by a lot. We've seen restaurant stocks stumble. We've seen a lot of other areas of consumer spending be called into question. But the one thing that never slowed down, even for a minute, almost at every segment, every level, has been travel. And as a result, on this show, we've been spotlighting best stocks like Marriott, like Expedia, like we did the airlines, we did Delta, we did United. Today I want to talk about Hilton. So Hilton is the same business model as Marriott. People think they're in the hotel business. They're not. They're in the points business. So they own approximately none of their hotels. I think they own maybe 40, 50 hotels. The entire chain is owned by developers and franchisees. And what Hilton does really well is run this asset-light, sort of like marketing / loyalty points business, and they're making tons of money. And you can see in this chart, the stock's been a winner all year. That little blip down was Liberation Day, and that problem was fixed relatively quickly. And it has spent most of this year in an uptrend. The stock had incredible earnings, just like Marriott, in November. Next earnings reports are not until February. And what we're going to hear in February is that these companies have just experienced record-breaking traffic volumes, RevPAR, any metric that you would value these stocks on for this fourth quarter. And I think they'll be guiding higher for next year. And I think that's what these charts are telling us. So in the column, we've got specific levels. We've got risk management levels as well. We never go into a name without knowing where we're wrong and where we want to be stopped out. But I do believe that these stocks will remain in uptrends. And there's more than just Hilton. This just happened to have been the one that caught our eye technically. And Frank, we'll be keeping an eye on this group as we get into next year.
All right, I'm looking at one name on this list. It's Delta. Jim, you're owner in this one. Your view on the travel trade more broadly, we were just talking about weakness in the labor market and some concerns there, and also inflation. Does the travel trade continue in 2026 with these concerns?
I think it does. I think it does. You know, if I look at Delta as just emblematic, and Josh is obviously looking at Hilton, but if I look at Delta, what I see is everything's going right. You got low fuel prices, you've got labor contracts in place, you've got very high capacity utilization, and that capacity utilization is at the front of the plane where they make the most money. They're paying down a lot of debt. So if you're going to get bearish on Delta or the travel industry in general, Frank, you got to go back to what I said earlier about you've got to see a recession. And if you're going to call for a recession, it's kind of like you're licking your finger in the wind and saying, yeah, I think the wind is going to change here and blow the other way. There's just no evidence of it happening.
Yeah, just anecdotal. If you try to get one of those Comfort Plus seats, like they're sold out immediately.
Well, they're kind of overblown anyway. They really are overblown.
Well, I'm pretty tall, so I need a little leg room, Jim.
We've got to move you a little further up in the cabin, my friend. I'll work on that with you.
Thank you.
That builds AI agents. Mackenzie Sagalos has more in today's Tech Check segment, Mac. And it's interesting to see Meta outperforming, too.
Yeah, it is. Investors are bullish on this. And part of that is the fact that it's a deal that speaks directly to the pressure Meta CEO Mark Zuckerberg is facing to show returns on the company's massive AI spending, and one that straddles the increasingly complicated U.S.-China AI rivalry. So Manus had a mini viral moment back in March. The company claimed that it outperformed OpenAI's deep research. People were calling it China's next DeepSeek moment. The K-Web was running up while the Mag 7 was selling off. Now those trades have reversed. But the talent and tech that spooked investors this spring, that's now inside of a U.S. tech giant. No terms officially disclosed, but the deal reportedly values Manus at more than $2 billion, a big jump from the $500 million valuation when they raised this spring. One analyst saying this deal has the makings of a future Instagram or WhatsApp-style home run, adding that agentic AI plugs right into Meta's push to monetize SMB business tools, especially the services that it offers internationally via WhatsApp. And from Silicon Valley, the read on why Meta paid up is blunt. One VC telling me that Meta has no real AI products with traction. Manus, on the other hand, is a strong business, $125 million in annualized revenue by December, gaining 20% plus month over month, but struggling to grow into something that could really IPO. So this is Meta buying one of the only viable consumer AI app successes out there. Meta says Manus will stay standalone for now, but the product will also get woven into its products over time. It is a big integration test for Chief AI Officer Alex Wang, coming after 4 reorgs of his department in 6 months as CEO Mark Zuckerberg races to make the spend pay off. Guys?
Yeah, and Alex, a product of a deal himself, of course, what they paid $14 billion for part of Scale AI, although that company's kind of what was left of it is sort of no longer. I mean, are there more to come here, do we think? And, do we have a sense in terms of how, I mean, this company's growing so fast, Mackenzie, I do wonder the impact it could have pretty quickly.
Well, I mean, to your earlier point, you spoke to Gil Loria earlier about the fact that Meta has spent $30 billion on a mix of talent acquisitions, 14 of that, as you just noted, to bring Alex in-house. And we're still waiting to see return on that. But Zuckerberg has the voting power to be able to make those kinds of decisions. So as for whether more are coming, certainly, yes. There's not been any sort of, I mean, in the last week alone, we've seen 3 more deals from SoftBank, from NVIDIA, really leaning into the fact that these acqui-hires are not being checked. And so in that kind of regulatory environment, why not lean in? And at roughly $2 billion, it's not even that big a purchase. And their SMB enterprise services are $10 billion annualized. And so if you can soup that up with an agentic AI offering, that's a really strong product to bolt on.
I mean, it also just... It increases the concentration risk, which I just keep saying. But as these, as the big powerful ones get even bigger, even with these smaller acquisitions in the AI space, it creates a level of vulnerability ultimately for the market if we do see unraveling like we saw little flashes of this year.
And when you think about that Mag 7 contingent, you've got Elon Musk, Jensen Huang, and then, of course, Mark Zuckerberg, which are these founder-led companies where they do have the voting share to be able to make these kinds of decisions without answering to a board of directors. So certainly you are seeing some consolidation. I mean, just in the last week, as I mentioned, NVIDIA buying Grok, a smaller AI chip company that gives them a real advantage in the memory space, which has been one of the hottest performing stock sectors in 2025.
Yeah. As you point out, of course, Zuckerberg, 61%, I think, of the vote, lets him do what he wants. By the way, shareholders applauding it. I mean, the increase in market cap is some $18 billion today for $2 billion that's been spent. Mackenzie, thank you.
Joining us is Dan Greenhouse, Chief Strategist and Managing Director at Solus Alternative Asset Management. How are you feeling, Dan, going into next year after we've chalked up another double-digit gain for the market this year?
I still feel pretty good. I keep talking about that, yes, the calendar has turned, but what are the themes still at work? And the AI theme is still driving markets top to bottom. And we're talking about the SoftBank deal today. It's hard to imagine that this theme ends when you keep getting headlines like this of this size. And so I know everyone's worried about all the worries that we've expressed day after day, week after week. But at the end of the day, that theme still seems relatively in place for me. And with it, it probably continues to drive markets higher.
Which is just the sheer spend on AI?
It's the fact that we haven't fully adopted it yet. Companies are only beginning to sort of implement it in a meaningful way and get the productivity and efficiencies that are going to help support margins. But yes, the amount of spend and every single conference call that we listen to, every conference that these guys appear at, they all keep telling us demand is greater than supply. And at a minimum, you want to see, for this to end, you want to see that slow down. And I haven't seen any evidence of that
yet.
yet.
There's been no let-up. Obviously, we're just through the last quarter in terms of all the hyperscalers and everybody else.
That's right.
Reaffirming or increasing their CapEx plans. That said, the bigger question, I don't know, are we going to get it answered in 26, which is, what's the return going to look like on all that invested capital?
I know everyone keeps talking about this, that this is the year where we're going to have to see the return. I don't know that that's the case. I mean, it could just be another year where we spend $1 trillion. Obviously, there's some differences because now we're tapping the debt markets to a greater degree than before. But as you know, all these companies have basically their leverage is basically a half a turn.
Many of them, not Oracle.
No, Oracle's the exception at the 3 or 4 times debt to EBITDA. But the Meta and the rest of them are called half a turn of leverage, so they're not particularly leveraged. So they can, and we know the IG market is 10 trillion in size, give or take. So there's ample room for this to continue. But I know, again, the main point is people keep saying we need to see, we need to see, we need to see. It seems like, to me, like a nice thing to say something different, but I don't know that that's rooted in any.
So we're just going to sit here next year, have the same conversation that we're having right now?
Why not? I mean, listen.
Now, what does that mean for the S&P?
Well, listen, this is the argument that as long as these companies are as large as they are, you need to continue to be, if this is what you do, it's not what Solus does, but if this is what one does, you need to continue to be exposed to those names because you're just going to underperform. But at the same time, we've seen, as everyone has noted, some change in allocation here. Some of those larger names have sold off. Even some of the derivative names like Eaton and Vistra and Vertiv have sold off, and other names have picked up the slack, healthcare, financials, some materials names. So you're starting to see a rotation. So that's really the question, I think, going into next year, not whether the AI story is going to blow up, but rather whether you want to continue to be exposed to the largest, most obvious names rather than something else.
Hey guys, welcome back to my channel. I hope you all are doing well today. We are getting some fresh breaking updates today coming directly from the Reuters, and this one is extremely important. According to this report, NVIDIA has confirmed Chinese client that is planned to begin the shipping its second most powerful AI processor, the H200, into the China by mid-February. This is very soon. This is significant because the H200 has been at the center of the long political and the trade debate in Washington. Until now, NVIDIA has been operating as if China revenue will stay at zero. The report indicates that between 5,000 to 10,000 H200 modules could be shipped in the initial phase. But nothing is final until the Beijing gives the official approval. And that is where the geopolitics become extremely important. China has already rejected previous NVIDIA models that were specially redesigned for their market. So even though NVIDIA is preparing shipment, everything still depends on regulatory green light from the Chinese authorities. This also raises the question of whether the US government will continue using semiconductor access as a negotiation tool in the trade discussion. Rare earth materials, agricultural exports, soybean purchase, and the chips access are all now part of the same political chessboard. The core issue is simple: who control advanced computing control the future economy. And right now, advanced AI chips are the one of the most powerful bargaining tool on the earth. From an investor perspective, Nvidia's valuation still look attractive compared to its long-term historical average. If you are bullish, then you likely believe we are still in the early phase of a multi-year AI capital expansion cycle. If you are cautious, you can probably resolve around the power shortage, cloud funding, and the infrastructure bottleneck. But overall, the reality is Nvidia chips continue to produce extremely high return for the customers, and alternative architectures from TPUs to custom AI accelerators are expanding alongside Nvidia, not replacing it. This is not a zero-sum game. This is an entire computing economy being built. Now here is what makes this situation even more interesting. From multiple quarters, Nvidia has officially modeled zero revenue from China. If China reopen in any meaningful way, even partially shipment could trigger major upgrade it to revenue forecast and the stock price target. China was once Nvidia's second largest market. Reopening that channel would be represent tens of billions of dollars in a potential revenue over the time. Another major data point released recently showed that the OpenAI significantly improved its computing efficiency, reaching around 17% of computing margin, up sharply from the prior year. While this is not a gross margin, it is strongly suggests that NVIDIA hardware continues delivering the superior total cost of ownership and the operational efficiency. Simply put, the faster models runs, the more revenue customers generate, the more they reinvest back in the NVIDIA system. Performance become profit. NVIDIA has also quietly restructured its internal cloud division to support its own R&D needs, signaling that company expect to consume massive compute internally as it pushes deeper into the open source models and advanced research. This is not demand slowdown. This is NVIDIA preparing for the next generation of AI workload. Now let's talk briefly about the iron. Iron continues to strengthen its position as one of the most strategically placed AI infrastructure builder in the world. They control land, power, cooling, compute, and the grid access, which allow them to capture the margin across the full AI center stacks. They are currently expanding rapidly, with over 1,200 workers active on site and a multi-gigawatt renewable power footprint. Iron is forecasting as AI cloud revenue run rates exceeding the $3.4 billion annually by 2026, representing exponential growth from the today numbers. And importantly, this is a high margin AI cloud revenue, not a commodity crypto mining. Looking ahead, Jensen Huang will deliver two major keynotes at CES 2026. While CES is a consumer focused, any forward looking guidance on robotics, physical AI, or computing infrastructures could act as a near term catalyst for NVIDIA stock. But even without new announcement, NVIDIA remains structurally positioned for the long term expansion. The most undisrupted growth engine is physical AI. Robots, autonomous systems, factories, and the smart infrastructure will define the next decade. And NVIDIA is building the foundational platform for the world. Omniverse for stimulation, CUDA for training, AGX for edge interfaces, GPUs clusters for AI factories. Over 2 million developers are already building on NVIDIA robotics stack. This is the next leg of the AI supercycle. Production ramps are also lining up far into the future. Blackwell Ultra is already accelerating revenue growth. Rubin launches in 2026. Rubin CPX follows. Rubin Ultra and Phenomenon stretched the roadmap through 2028. Jensen expects 3 to 4 trillion in the global AI factory build-out by 2030. That means this is not a short-term boom. This is a decade-long-term infrastructure transformation. This is not a bubble. We are still in a shortage mode. Short on power, short on memory, short on compute, short on data center. This means demand has not even peaked. And with all of that, I continue to believe Nvidia will be substantially more valuable in the future than it's today. Stay patient, stay long-term focused, and avoid emotional decision. Let me know your thoughts in the comments. Leave a like if this helped you, and consider subscribing. Thanks for watching. I will see you in